back is turned up.
If you guys end up losing this handout, it is on Blackboard. Okay, so chapter 6, it starts on page 189, and we're still talking about the world of finance, and we're still trying to explain to you how companies fit into the world of finance. And so it starts out then on page 190, where they're talking about primary and secondary markets. But what I first want to kind of explain to you is, like on page 191, kind of going through then how a company is participating in the world of finance. So basically what we're seeing, kind of going back to one of our first lectures, is that you've got a company, and think about the company as the group of people that have a really great idea on how to make money. Okay, so they know they've got a business, and they know how they can make money doing whatever they want to do. But remember we said that in the world of finance, what happens is that you have these companies that have really great ideas that don't necessarily have the money that they need to finance their company. And then we also have a group of people then that have money that they need to invest, but they don't have any really great ideas on what to do with that money. So we said that that's where the world of finance starts to come to play and make those two groups meet so that the savers can meet the companies. So in this first example, what I'm trying to show you then is that, let's pretend like we have what I'm going to call saver number 1 and company number 1. So what's going to happen then in the world of finance, saver number 1 would give money to company number 1 in exchange for, and it could be a stock or a bond, or maybe they've given a loan, but let's pretend like in my example that we're getting stock. So the saver gives the company money, the company gives the saver a stock, bond, loan, whatever, but we're going to just say stock for the example. So in this type of a situation, we would call this a primary market transaction. In the primary market, what's happening is the company's getting the cash. The company is getting the cash. So from there, the company can do whatever they need to with that cash. So the company could go out and they could either pay off other debt, buy out other shareholders, or a better situation for the shareholder would be that they would go out and buy more assets. Because if they're just paying off other debts or buying out other shareholders, that's past business. Whereas if they're buying assets, that's them investing for future business. But you don't always know necessarily what a company is going to be doing. So saver number 1 gives their money to company in exchange for a stock, primary market transaction. The secondary market transaction is when saver number one decides that they can't hold that stock, bond, whatever, any longer. In this case, we're going to say a stock. And so they need to sell it. So they go out into the marketplace and they sell that stock to saver number two. So in this transaction, the stock goes from saver number one to saver number two, and saver number two gives their money to saver number one. Secondary market transaction, the stock and money is changing hands between two net savers. The company isn't benefiting from that. The company's not getting any cash. That's a transaction between two savers. So that's the difference between the primary market and the secondary market. In the primary market, the company gets the cash. In the secondary market, it's a transaction between two savers. Let's go back then and focus on just the primary market. Let me get a decent eraser. What happens in the world of finance, and I kind of already alluded to this in another lecture, is that sometimes the company and the savers don't know who each other are. So if you're running a company and you're spending 40, 60, 80 more hours a week running your company, maybe you don't know who the net savers are that have money that they want to invest. Because finding savers that have money they want to invest is one challenge. Then finding the savers who want to invest in your industry, and then even more specifically in your company, that's even more of a challenge. So that's when the world of finance starts to come into play to help those two groups find each other. So again, this is all going to be primary market. But let's do an example now where we put what we would call, I'm just going to say FI, financial intermediary in between the two. So what it's going to look like if we put a financial intermediary in between the saver and the company. So the first financial intermediary I want to give you as an example would be an investment banker. So if the company and or the net saver uses an investment banker to help them, what happens is the investment banker then finds the savers that want to invest in the industry and the company. And then what happens is the money then flows through the financial intermediary, in this case the investment banker, and in exchange then the stock also flows through that financial intermediary, in this case the investment banker. Now here's what's happening. In our first scenario, when the saver just went to the company and gave them money in exchange for stock, and again we're going to be saying common stock, let's just talk about common stock in this class. That saver number one became the shareholder of record. So if you would have gone and done any kind of a search for who was one of the owners of that company, you would have found that saver number one's name. So they would have had all of the rights that you learned in Accounting 210 that a common shareholder would have. They would be getting the proxy or vote, they would be invited to shareholder meetings, they would get then the dividends, etc. They would be the shareholder of record. The same is going to be true if an investment banker is used. If an investment banker is used, the investment banker never owns that stock. It's like they have it as inventory. The investment banker's name would never be on that stock. They're just trying to help find the company and the savers that want to be together. So at the end of this transaction, once again, the saver would be the shareholder of record, and they would have all the rights that would come from being that common shareholder. In exchange, what the investment banker would get is they would get some kind of a commission or some kind of a fee for getting those two matched up. So both of those are primary market transactions, whether the saver goes directly to the company or whether an investment banker is used. In the end, the company is getting the money. Another example then, questions or comments so far? Another example of a financial intermediary that a lot of you will probably use in your lifetime would be a mutual fund. This is how a lot of people invest for their retirement. They use mutual funds. So what happens with a mutual fund, being the financial intermediary, is that a lot of savers send their money to the mutual fund. What the savers get in exchange for giving their money to the mutual fund is a unit of ownership in that mutual fund. So the mutual fund manager is basically taking all of the money from all of the net savers and pooling it all together. So then what happens is the mutual fund manager goes out and buys the stocks or the bonds in different companies. So the mutual fund manager has pooled money from a bunch of savers, given the savers units in that mutual fund, and then once they pool that money, they go out and buy the stocks or the bonds in the different companies. So this is one way where a saver can become more diversified. Because if they have a limited amount of money that they want to put into the market, they can buy into a mutual fund then that has the power to go out and buy stocks and bonds in a bunch of different companies. What happens though is that the transaction here where the savers go and invest in the mutual fund, that isn't making the savers be the shareholder of record. Actually what happens is the mutual fund becomes the saver of record then, or the investor in the companies. So if saver number one went up and looked at company number one, knowing that that was part of a mutual fund that they participated in, saver number one's name isn't going to be there. The mutual fund's name is going to be there as the investor. So then what happens is, it's the performance of the mutual fund basically being the performance of the companies that the mutual fund manager has invested in. And then the mutual fund manager has to report then to the savers. So let me give you an example of how that would work as compared to investing individually. Let's pretend like we're sitting here at Finance 340 and we decide we're going to invest in company number one. And then we're going to each go out and take our money to company number one. In exchange, then we all become shareholders. And then as we meet every Tuesday and Thursday, we're going to discuss then how we think the company needs to be run. So that when they come to us as common shareholders and ask us our opinion on different topics about how the company should be run, think about it, we could all talk together and have kind of a concerted voice then on how we want to vote our shares. But then once Finance 340 is over with at the end of the semester, and we all disperse, chances are there's never going to be a time that we can all get together again and talk about how we feel the company needs to be run. So it becomes harder for us to have as much control over the managers. So kind of go back to our last lecture about agency relationship. Remember, the managers are supposed to be working for shareholder wealth maximization. So as we all were meeting every Tuesday, Thursday, we'd have a way to discuss the issues, talk about the managers, talk about what we want them to do. But then as we disperse, we're not as strong of a voice. So now think of that then as opposed to what would happen if we developed a mutual fund. And let's pretend like we all decided we wanted to invest in company number one, and so all of you passed your money to me, and if you ever want to do that, that's fine, we can do that. Okay, you're not awake because you didn't laugh, or that's just really not funny. Okay, so if you guys all passed your money to me, and I became the mutual fund manager, then I would take all of our money and I would go and invest in company number one. Then again, every Tuesday and Thursday we would meet, and I would take the power of all of your money and be the one voice for all that money. And then once we couldn't meet, you guys could still be in contact with me, and I could still be the strong voice then, having the power of all of your money behind me. And so that's what you see in the financial environment now. A lot of these mutual fund managers have a lot of power because they have the voice then of all of their investors. The other thing that's happening then is the mutual fund manager has to answer to the investors. So guess what? If the company isn't doing very well, you guys can't talk to the company. You guys are coming to me and you're unhappy. So the mutual fund manager, they have pressure, and the companies that they're buying into have to have good performances because then they have to answer back to all of these savers. So when I was in the Fortune 500 world, a lot of times what you hear in the financial press, they'll talk about quarterly earnings, annual earnings, things like that. Well, honestly, it's really more than just that. It's monthly earnings that everybody's concerned with. When we would get to month end, we might have a day or two before a mutual fund manager would roll up in the limousine and want answers. Why were our numbers the way they were? So whether the numbers were worse than budgeted or better than budgeted, they wanted to know what the differences were. Because you know what? They had to report it back to their savers. And they had to make sure that they understood what was going on, because the savers, if they don't like the mutual fund manager, they can pull their money out. So if the mutual fund manager doesn't like the company, they can pull the money out. So that's a lot stronger voice in the agency relationship than if individual investors go in by themselves. Because if we had all invested individually, if just one of us pull our money out of company number one, that doesn't send as strong of a signal to company number one as if I'm the mutual fund manager and I pull all of our money out of company number one, because I don't like the way management is working. So then the threat of firing becomes more real to managers as you have this stronger voice, and or the urgency of making sure that they're working for the shareholder wealth maximization, because they have a block of stock that's owned by somebody with a really big voice. So that's what you're seeing in the first few pages then of chapter 6. Also on the bottom of page 90, they start talking about initial public offering. Initial public offering is the first time that a company can publicly trade their stock. In other words, it's the first time that anybody in the public can own that stock. So what we mentioned in one other class was there was one company that I went with where I bought stock, and the only other people that I could ever sell that stock to was the company itself or another manager of that company that was already a stockholder. So then if that company had gone public, that would be the first time that I could sell my stock to anybody I wanted to anybody in the public. So one of the common misconceptions with initial public offering A lot of times people think that that is a primary market transaction. They think that it's the company getting all of the money from the stock that's being sold. When really, in an initial public offering, what can happen is that can be primary and secondary market transactions. Because once again, that's the first time that some of these shareholders have been able to sell their stock to anybody that they want to. So probably one of the most recent ones that people would remember in Wichita, Kansas, was when Spirit went public and had their initial public offering. So what happened there was a group of people had bought in, very closely held company, and it was the first time that those owners then could sell their stock to anyone that they wanted to. So in that initial public offering, I don't remember the exact split, it was like 60-40 or something like that, that was primary market transactions and secondary market transactions. So it wasn't like Spirit just got this big hunk of money that day. Some of that was going to the shareholders for their first time to be able to sell their stock publicly. So that was the term on page 190. On page 192, they talk about money markets. Page 193, capital markets. Don't spend too much time memorizing which is which. I mean, basically a money market, is something that's less than a year maturity. Capital markets, more than a year. We're going to be talking about stocks and bonds, and so we're going to be looking at capital markets. Stocks never mature. Bonds, a company's not going to put a bond issue out there and have it be outstanding less than a year. That just doesn't make sense. So we're going to be talking about capital market transactions. They talk about then physical locations, like the New York Stock Exchange is a physical location where stock is traded. That's different than the over-the-counter market. In the over-the-counter market, stocks that are traded over the counter, there isn't a physical location where they're being traded. It's all just basically computers, electronically. That doesn't mean that if you go home and you log into your computer and you use some kind of a website or some kind of a broker on the web to buy a stock fee, that doesn't necessarily mean that's an over-the-counter market transaction. Because if it's a company that's traded on, for example, the New York Stock Exchange, then somebody is physically going and making that trade for you. So just kind of understand the difference there. There's a whole class on investments, Finance 620. So we're going to not spend a whole lot of time on the part of the chapter that gets into the investments, because like I said, there's a whole class on it. So go over to page 203 and pull out the handout that I gave you. On your handout, it starts out showing you that a quoted interest rate, so I'm going to make that be an R, is your R star, your inflation premium, your default risk premium, liquidity premium, and maturity risk premium. So we're going to go over all of these individually. So that's the equation. The quoted interest rate, R equals R star plus IP plus DRP plus LP plus MRP. So the first variable, the R star. What we're trying to do, kind of let me back up a second. What we're trying to do, once again, is explain to you what it's like then for these companies to compete for these net savers. So what we're saying then is a quoted interest rate, or think of it as a rate of return, that people are going to be requiring is based on the risks that they're taking. Remember I told you the term risk averse? Risk averse, A-V-E-R-S-E, means that the more risk that someone takes, the more reward they're going to require. So if you're risk averse, which an investor is, as you move down this equation and you look at the risks you're taking, you're basically adding to the rate of return that you're going to require. So the math is supporting that theory. So the first variable you see, R star, that would be an interest rate that you would get if there was no inflation. Okay, so R star really doesn't exist. So what we're saying is what you have to add to that is inflation premium, IP. Because in my lifetime, in your lifetime, there's probably not going to be periods where there isn't any inflation. So when you're looking at a quoted interest rate, usually what we say for a risk-free interest rate, we're going to consider R star and inflation premium. As we discuss these, what we're going to talk about is the difference between a Treasury security and a corporate security. When I just said the term risk-free, in the United States, what we deem is anything that is issued by the U.S. Treasury, we're deeming that to be risk-free. Risk-free. Anything issued by the U.S. Treasury, we're deeming to be risk-free. What risk-free means is the return of and on your money. The return of your money. So if I go out and I put $100 into a savings account, that's my money. So the return of that $100 is guaranteed because of the FDIC rule saying that if I put that in a savings account, it's within the FDIC rule, so they're guaranteeing that that $100 is still going to be there. Now, if they tell me that at the end of the year, they're going to give me a return on my money, and this isn't true for a savings account, but let's pretend like it'd be 10%. So the $100 I put in, and then the 10% that they're saying that they would pay me, the $10, so if I go at the end of the year, the return of my money would be the $100 that I put in. The return on my money would be the $10 or the 10% of it that they're saying they're going to put in. So that's the term risk-free, the return of and on my money. Risk-free, it's deeming that I'm going to get both. So with the U.S. Treasury Security, you're going to get the return of and on your money, so that would be your R star and your inflation premium. So what's going to happen then in the corporate world, in order to attract people who are the net savers from going and putting their money in a savings account, then they would have to look at what someone would get if they went and put their money in the savings account and pay them at least that. If I can get 10%, and I know I can't, okay, I'm just making up numbers. If I could get 10% in a savings account, I would at least require 10% from a company. A company's not risk-free. Think about it. A corporation, they can't go and raise taxes on people to get money like the government can. What they have to do is they have to make a sale. And then they have to make money from making that sale. So they're not risk-free. We're saying the U.S. government is because we're believing that they would raise taxes, do whatever they needed to get us the return of and on our money if we're buying a U.S. Treasury security or investing in something that is insured by the U.S. Treasury. Default risk premium, DRP, default risk premium. That's the risk that you wouldn't get the return of, or I should say, on your money. The default risk premium. So for a U.S. Treasury security, we're saying that doesn't apply. Because for a U.S. Treasury security, we're saying that they're guaranteeing the return of and on our money, so there's no default risk. And if you guys were paying attention to the financial environment a few years ago, they were saying, well, we might have to downgrade U.S. Treasury securities because the U.S. government's getting too risky, they're getting too much debt. Me being a nerd, I'm thinking, oh no, how are we going to teach Finance 340? The authors never changed it, so we still kept teaching it this way. Okay? So, we're saying that the U.S. Treasury, we still have full faith in the U.S. government that they won't default. Like I said though, with a corporation, that's not true. You are taking risk. Because they have to make a sell. And they have to get income from that sell. And they have to be able to pay you not only the interest, but also the principal that you're investing. So the return of and on your money. What happens with corporations is they have a lot of rating companies, well not a lot, 2 or 3, where what they'll do is they'll rate a corporation. So if you have a corporation that has what they say a AAA rating, then that's as close to risk-free as you can get and not be investing in U.S. Treasury securities. So these are really large, very established companies. They've been in business for a long time. They really don't have a lot of movement in that company. There's really not a lot of risk there. Depending on the rating system, on how they work, on where their cutoff is, I'm just going to use a B for now. Because one of the rating systems, that's where their investment grade stops. Investment grade meaning you're still pretty highly likely to get the return of and on your money. Anything that's not considered an investment grade security, you start to lose your confidence that you're going to get the return of and on your money, so your default risk premium should be a higher number. All the way down to what they call a junk bond. I'm sure you guys have heard that term before. A junk bond, if you listen to the financial press, is a bond then that you're buying that the company is very highly likely that they're going to go bankrupt. If the company is very highly likely of going bankrupt, then the return of and on your money is pretty iffy. So the only reason to buy them would be because you think that you can get a huge default risk out of it. The next variable is LP liquidity premium. Liquidity premium. Remember with our liquidity ratios, that was how quickly we were going to get our cash so that we could pay our own bills? This is kind of similar. Liquidity premium here is how quickly can I sell that stock or bond if I need to? How quickly can I sell that investment? With U.S. Treasury securities, we're going to deem that any time that the markets are open, you can buy and sell those Treasury securities. So there's not going to be any liquidity premium. With corporations, if it's publicly traded, then that would carry that same characteristic. Anytime the stock market is open, if it's a publicly traded stock, you can probably buy and sell that stock. It might not be the price you want, but you could get it sold if you needed to. I'm saying, but liquidity premium is going to apply because not every company is publicly traded. So go back to my extreme example, liquidity premium, if you're buying a stock and you can only sell it back to the company or another manager of that company, that's a huge liquidity premium. Because if you want your money back, you're going to either have to take whatever the company or one of those other shareholders, one of the other managers is going to give you, or you're not going to be able to sell it. Because if they don't want to buy, you're not selling. So liquidity premium is how quickly can you get that investment sold if you need your money back. Maturity risk premium is going to be applicable to both the Treasury security and the corporate security. Maturity risk premium has basically two elements to it. I'm going to draw a little timeline up here. On the timeline, the left-hand side, the 0, that's time period 0. That's today. That's when you're buying a security. So let's pretend like we have a security here. And let's pretend like I go out and I buy a security. So this is me. And let's pretend like I bought that security this morning. And let's pretend like I come to class, and I never really do this, but let's pretend like I come to class and I say, hey, I bought this really great investment, and I am going to earn 10% for the next 10 years on this investment. Okay, so that was this morning before class. Let's pretend like you leave class, and you go out, and you buy into the same security, and we'll prove how this can happen once we get into chapters 7 and 8, so just trust me that this could happen right now. Let's pretend like you buy into the same security, and you call me at about 1 o'clock, and you say, hey Peggy, I'm a little confused, because I bought that same investment that you bought, but I'm being told that I'm going to earn 12% over the next 10 years. But you said we were only going to earn 10%. Okay, remember, my example is about me. This is all about me. Okay, I'm the original investor, so I want it to be all about me. How do you think I feel? You and I own the exact same security, except you're going to be earning 12%. Look, we're taking the same risks. I mean, we're in the same company. It's the same default risk, the same liquidity risk. So what's happening then is that you went out a few hours later, and now you're going to make more money owning that same security over the next 10 years. So for me, the original investor, that hurt me, didn't it? Okay, so interest rates went up. You locked in at a better rate. So that's when the original investor gets hurt. Think about if the other scenario had happened where you invested and you called me at 1 o'clock in the afternoon and you said, hey, I invested in that same security, but I'm confused because you said we were going to be making 10%, and they told me that the way I invested, I'm only going to be making 8% over the next 10 years. Okay, remember, it's all about me. I'm the original investor. I'm not sad. I'm sad for you, okay, don't get me wrong. But I'm not sad for me because we're taking the same risks. But I'm getting a 10% reward and you're getting an 8% reward. So I locked in at a higher rate, we're taking the same risks. So the original investor, me, was only hurt when the interest rates went up while I owned that security. So let's pretend like 10 years passes, and we're standing here, and we get our original investment back. Let's pretend like we invested $1,000. So I get my original $1,000 back. And remember, it's about me, and I'm the original investor that's been earning 10%. Okay, in this case, let's go back to you making 12% along the way. Let's pretend like interest rates stayed the same, the 12%. Well, here, let me back up. If it was that interest rates stayed 10%, it's really no issue. If interest rates were 10% when I bought it, they stayed 10% all along the way, I get my money back, I reinvest at 10%, there's really no issue. Okay? Let's go to where I was hurt, though, originally. So when you were making the 12%, I was hurt for the 10 years, but let's pretend like the interest rate stayed at 12%. When I get my $1,000 back, I'm happy to go and get it back and invest at 12% if the interest rate stayed up. Because that's like I'm getting a pay increase. I'm getting more money. So then I'm happy. So I'm not hurt if I get my money back and I can invest it at a higher rate. But if the opposite happened, if interest rates had fallen, and remember at first that didn't hurt me because I was earning 10% and you guys were earning 8%. But once I get my money back, because it matured 10 years later, I'm used to making 10%. If I have to go and reinvest and only make 8%, that's like I'm taking a pay cut. I don't make 8%, I don't make 10% anymore, I'm only making 8%. If I was using that to pay my bills, to live off of, it's like I've taken a pay cut. So this is kind of what's happening in our environment right now with people who are investing. You'll hear that there's a lot of money out there waiting to be invested. The reason is because people don't want to invest here, like for my example, 10%, and then find out that a few days later, a few months later, a few years later, since they were locked in at 10%, other people are locking in at 12%. And another thing that happened to a lot of people was if they were invested in bonds and they matured, if they were used to making 10%, then they looked out and interest rates had dropped on them, and they don't want to lock in at these lower rates because they're afraid that then interest rates, once again, will go up after they've locked in. So you have all these investors who don't know what to do because interest rates have been at an all-time low for a really long time. But they're afraid to lock in because they're afraid interest rates are going to go up and they're going to get hurt. And they don't want to live on this reduced budget. So you see that happening in the marketplace a lot. So those are basically the quoted interest rate variables. Any questions or comments on any of those?
Some of those investors went into the marketplace and invested. Are there economic reasons that they would think that the interest rate would go up and that they'd be hurt by that?
That's kind of getting into the economics of it. He was saying if some people go into the marketplace and start buying up these investments, then would that put some pressure on the interest rates to go up? Remember what's happening is the Fed is controlling the interest rates, the Federal Reserve. And there was an announcement lately that they did inch them up a little bit, not very much. But it really didn't cause a huge influx into the marketplace. Again, people are wondering, okay, if they inched them up now, are they going to inch them up some more? Yeah, when are they going to do it next? Because it's been years since they did that. So they're trying to see what that really does to the economy to see, before they make their next move.
Have you seen the movie Wolf of Wall Street?
Yes, I have.
Okay, what are penny stocks rated in the bonds there? Like from AAA to B, are they considered a junk bond or like how do they have their own individual ratings?
Okay, so the question on that was regarding penny stocks, and I really don't want to get into that because that's like the whole finance 620 thing. But basically, just because it's a penny stock doesn't necessarily mean anything always. I mean, it's a term, but a lot of times what they're saying with a penny stock is that's going to be then looking at the face value. So I mean the book value, if that makes sense. So I mean that's like a whole conversation that would probably take me 20 minutes to explain. So if you want to talk to me on the side about penny stocks, I'd be happy to talk about that. Okay. I need to stay on task. Other questions or comments? Okay, on page 200, they mentioned some special provisions and covenants. You guys might want to just kind of read through some of that, but don't spend a lot of time on that. For learning objective number 5, the expectations theory, that's the last thing that I'm going to touch on in this chapter, so don't spend a lot of time reading through any of the other theories. And honestly, the expectations theory, I set up a little bit different than the author, so let me erase the board and then we'll talk about it. You will be responsible for that quoted interest rate equation, and you will be responsible for the expectations theory equation. So in the book, if you've already done the reading, what happens is the author presents this. Let me wait for the board to dry. The author presents the expectations theory as if So the author presents the expectations theory as if you could walk into the bank today and you could see what you would get percentage-wise if you invest for 1 year. And then they pretend like you could also see what you would get if once that 1 year passed, what you could get for 1 year a year later. So meaning, they're making it sound like if you walk into the bank, you can see what you would earn on a 1 year CD today, and then what you would earn on a 1 year CD a year from now. I've walked into a lot of banks and I've never seen that. Okay, what I see is what I would get if I invest for 1 year, or what I would get if I was willing to invest for 2 years. So with the expectations theory, what's happening is we're talking about something at the bank. So that's investing within the FDIC rule, so U.S. Treasury Security type thing, or at least backed by the U.S. Treasury. So if you look at our equation, that's R star plus inflation premium plus maturity risk premium. So we're saying if we walk into the bank and we invest, we're looking at R star inflation premium and maturity risk premium. But they're saying, well, with expectations theory for Finance 340, let's leave out maturity risk premium. Because we want to keep it simple. We want to keep it basic. So let's pretend like we invest for 1 year, the first year. Or we could invest, then we'd have to reinvest for 1 year the second year in order to make it be equal to investing for 2 years. Right? If I wanted to compare time frames on having an investment, if I'm ready to invest and I want my money locked away for 2 years, that's the example I'm going to use here. I would either walk into the bank and buy a 1 year security for 1 year, but then I'd have to reinvest the second year, or I would invest for 2 years. So here's what pure expectations theory is saying. It's saying that anytime somebody invests for 2 years, what the government has done is that they've looked at the inflation premium over the next 2 years and they've smoothed it out. They've averaged it. Remember, R star isn't going to change. I'm just going to make this up. Let's pretend like in our environment, R star was 2%. If I was only going to get R star, I would get 2% the first year, 2% the second year, or 2% for 2 years. Right? And remember, we're talking annual percentage rate. So if you invested for the 2 years, you'd get the 2% the first year and 2% the second year. You're not just getting 2% over 2 years. We're talking about an annual percentage rate. So when we talk about quoted interest rates, it's an annual rate too. So you get the compounding and everything. So the only thing that I'm really averaging then is in my inflation premium. So I'm going to make up some numbers. Let's pretend like I walk into the bank, and this isn't real. And if you walk into the bank and see this, call me right away, please. But if I could invest in a CD and get 5% for 1 year, versus investing in a CD for 2 years for 7%. Then the real question is, what would I get, or what would I expect, the pure expectations theory, what am I expecting that second year to look like? Okay, remember, if you read the author gave you first year and second year and had you calculate the 2 years. That isn't really doable. That isn't even really something that you can do in practice. So I'm trying to give it to you from a practical standpoint so that you can really use this. So what you're saying then is that your 7% is the average of 5% the first year, plus we don't know, okay? We don't know what we would get that second year. It's a simple average, so divide by 2. So doing algebra, I come out with the unknown being 9%. If I say 7% equals 5 plus the unknown divided by 2, Then I take 2 times 7 for 14, which equals 5 plus the unknown. So the unknown equals 9. Okay, so let's break this down. If I invested for 1 year the first year, I'm saying that's 5%. I said that 2% was the R star. So just using algebra, solving for inflation, inflation had to be 3% that first year, right? Because if I'm only saying R star and inflation premium make up that 5%, if 2% is R star, then 3% would have to be inflation premium. So then that second year, I'm saying that would be 9%, so 2% for my R star. So inflation premium would have to be 7%. I can double check myself because I said 7% over the 2 years, 2% being R star, so 5% inflation premium. I could double check that because I'm saying 5% inflation premium is 7 plus 3 divided by 2. 7 plus 3 is 10 divided by 2 is 5, so that checks out. That's my average inflation. Remember, only inflation is averaging because R star is staying the same. 2 plus 2 is 4 divided by 2 is 2, okay? That's not going to change. If I was just investing at R star, I'd be getting 2% no matter how long I lock my money away. So the difference in the interest rates, pure expectations theory, is just going to be looking at how they're forecasting inflation. Questions or comments on the calculation so far? Because I want to tell you guys how you use this in practice then. Everybody caught up with the calculation in your notes? Okay, here's how this is used in practice. First off, short-term interest rates are going to fluctuate more. Short-term interest rates are going to fluctuate more because you have less time period to average those movements of inflation out. If you go lock yourself away into a 30-year mortgage, that's 30 for your denominator. So all those movements in inflation, they're going to get smoothed out. Whereas if you only have 2 or 3 years, the movements in inflation are going to be smoothed out. Plus, think about it. If I lock my money away for 30 years, they can't change my rate of return, or they can't change what they're charging me for interest because I've locked into that amount. Whereas if I only lock my money away for a year, then every year I can get my loan percentage or my rate of return, whichever hat I'm wearing, change. So those interest rates are going to move more because they can. Okay, so let's think about it. Okay, so we said we're going to learn how to make business decisions and personal decisions with this information. So let's pretend like we have this information now. How are we going to make a decision using this? Well, let's think about it. We already talked about the maturity risk premium. We already talked about how all of this is starting to come into play and what we're looking at with inflation. So let's think about it first from the standpoint of I'm a company or a person and I need to buy a big asset. So I need to go out and I need to get a loan. Okay, so what I'm saying here is that I'm expecting, remember I'm standing here today at time period 0, and I'm expecting inflation to go up. I'm expecting it to go from 3% this year to 7% next year. I'm expecting inflation to go up, which is going to drive interest rates up. So if I'm at a place where I need to get a loan, I want to lock into the lowest interest rate possible. So I want to get that long-term loan sooner than later, don't I? I want to lock into that loan at the lowest possible rate. So if I think interest rates are going to go up because inflation is going to go up, I want to lock into that loan sooner. So I should get to buying those fixed assets, I should get my loans, I should get my transactions completed. The flip side would be true if I was an investor. Because if I'm an investor and I go to the bank and I think that I can invest for 5% or get an inflation premium of 3% this year, or inflation is expected to go up and interest rates are expected to start skyrocketing, then I don't want to lock in any too soon. Because if I'm an investor, I want to get the highest rate of return that I can. So if I think inflation is going to go up, interest rates are going to go up, I'm not going to lock into anything that's too long-term yet until I see what's going to happen with interest rates. Does that make sense? So whether I'm a person or a company, I'm going to wear that same kind of a hat. Now the problem becomes that the corporate treasurer is trying to get the lowest rates they can, but these net savers are trying to get the highest rates they can. So do you see where the parity starts to happen, where if you're trying to be the corporate treasurer getting the lowest rates, but these savers aren't willing to lock in at those low rates, then that's hard for you to attract that capital. So that's why you hear them saying that there's a lot of money out there that's not invested right now, and there's a lot of companies that would love to have that money that's not invested. But people aren't willing to lock into these low rates right now because they're afraid interest rates are going to go up. So when we get to chapter 7 and 8, you'll see then how that starts to impact bonds and stocks and the price of those. So if you guys can just kind of understand the variables then of the interest rate and that quoted interest rate equation, and then start to understand the expectations theory. For exam number 1, that'll help you guys understand then the concepts that we need to build on once we get into chapter 7 and 8. Questions or comments on chapter 6 then? I turned the recording off. The other thing that we needed to do then today was go over that additional information that was posted out there on Blackboard. That would be, it used to be the old pre-test stuff that some other professors do that I just went ahead and put on exam number 1. Do you guys want to talk about that today, or do you want to look at it over the weekend? I went ahead and reposted the answers. I couldn't get it to post yesterday. Blackboard was telling me that I didn't have the authority to post. I don't know why. So I didn't get them posted yesterday. I tried this morning. It let me post them. So I know you guys haven't had any time with the answers. That's why I'm offering. If you guys want some time with the answers, you're going to go going over it today, so you can kind of double check yourself. I understand. We would have time on Tuesday if you'd rather postpone it. So as a class, postpone it?
Yes.
Okay. The answers are out